What's up, everybody? Thank you for tuning in to another episode of the CPA Zone, the podcast where we discuss tax strategies and accounting tips for entrepreneurs and real estate investors. My name is Ryan Pulis, and our company, the Pulis Group, offers tax planning and advisory services for entrepreneurs like you. Whether it's bookkeeping, tax planning, or CFO services that you're looking for, we've got you covered. What's up, everybody? Welcome to another episode of the CPA Zone. Today, we're going to talk about like-kind exchanges, also referred to as 1031 exchange or a Starker exchange after one of the famous court cases. We did an earlier episode on 1031 exchanges, but it's been a while and it's a very popular topic, so I thought it'd be good to go back and revisit the subject. So 1031 exchange is actually one of the few real estate tax strategies that impacts multiple stages of the real estate life cycle. So the real estate life cycle, as a review, is simply the different stages throughout your real estate ownership. So in the beginning, you have your acquisition. So it could be acquisition or development. And then the longest period is operations, which occur during the period of time you own the property. And then at the end, you have disposition. So those are the three stages in the real estate life cycle. And there's different tax impacts at each stage. Well, 1031 exchange impacts both the acquisition in the beginning and disposition side, because you're essentially trading one property for another. So you're acquiring a property and losing a property or disposing of a property at the same time. So the 1031 exchange gets its name from the IRS code section 1031. As I already mentioned, it's also sometimes referred to as a Starker exchange after the court case. But in general, this section of the code, 1031, like-kind exchanges, allows you to defer capital gain and depreciation recapture on the exchange of real estate. So it used to be on the exchange of any like-kind property used in a business or held for investment. But in 2017, the Tax Cuts and Jobs Act changed the rules a bit, and now it's only allowed for real property. So if we look directly at the Internal Revenue Code, Section 1031, so Section 1031A1 says, no gain or loss shall be recognized on the exchange of property held for productive use in a trade or business or for investment, if such property is exchanged solely for property of like kind, which is to be held either for productive use in a trade or business or for investment. So some key words in there that tell you what the property can be used for to qualify for this exchange. So let's talk a bit about the current rules that govern 1031 exchanges. First, you have to use a qualified intermediary. So a qualified intermediary, they're a service provider that helps facilitate the 1031 exchange. So you have to use a third party. They're going to control the proceeds from the sale. You can't actually receive any funds. You can't have constructive receipt of funds, which means one of your agents receives the funds and you could have access to them. So your CPA cannot be a qualified intermediary. Your attorney cannot be a qualified intermediary. You're going to use a third party that performs this role professionally to help facilitate the exchange. So without the qualified intermediary, you are not going to complete a 1031 exchange. Next, as mentioned in the definition to 1031 exchange that we just read right from the Internal Revenue Code, the property must be held for productive use in a trade or business or for investment. So that excludes things like personal assets. Your primary residence is not going to be allowed to be used in a 1031 exchange. Now, perhaps you can convert that to a rental for a few years. Then you have a property that's being held for investment. But personal assets do not qualify. Also, this excludes inventory. So your fix and flips. You're selling the real estate. This real estate is being sold to customers. It's not being used by the business or held for investment. So that real estate does not qualify for a 1031 exchange. Next, the replacement property, that's the new property, must have a purchase price equal to greater than or equal to the selling price of the relinquished property, which is your old property. Now, this is required for total tax deferral, where you don't pay any tax. If it's less, that doesn't blow up the whole deal. You'll just pay tax on the difference because you're going to receive some sort of non-real estate, whether it's other property or cash, to make up the difference, that portion will be taxable. Next, it must be the same taxpayer. So the name on the deed of the property that you're giving up should be the same as the name on the deed as the new property. There are some exceptions for disregarded entities, such as a single member LLC that's disregarded for tax purposes, or perhaps a revocable living trust. But in general, it's going to be the same. The name on the deeds, both deeds will be the same. Then we have two timing rules. They run concurrently. Both start on the date that you close on the first property, usually the property you're giving up. So we have the 45-day rule, which gives you 45 calendar days to identify your replacement properties. Typically, you're going to identify up to 3. You do this by submitting in writing to your qualified intermediary the properties that you would like to replace your old property with. And the next timing rule is the 180-day rule, which basically says you have 180 calendar days to complete the entire transaction. However, this one, it's 180 days or the due date of your tax return. So if April 15th deadline falls in before your 180 days is up, make sure you file an extension, because then that gives you more time to file your return. It's the due date of the return with extensions. You want to make sure you give yourself enough time to close the entire transaction. There are also multiple types of 1031 exchanges. So you have a simultaneous exchange. That's when properties are swapped between the buyer and seller at the same time. Now, I don't ever see this actually happen, but it is allowed. We also have the delayed exchange. Now, this is by far the most common. So with the delayed 1031 exchange, the sale of the relinquished property, that's the property you're giving up, occurs first, followed by acquisition of the replacement property after a delay, after some time. So you have time to identify it and then close on the other property, while the proceeds from the sale of your property are being held by the qualified intermediary. By far the most common. We also have something called a reverse exchange. A reverse 1031 exchange happens when the replacement property is purchased before the relinquished property is sold. Now, the same timing rules apply, so it must sell within 180 days of the purchase and everything close, but that's also an option. And then we also have something called a construction or an improvement exchange. So this allows the investor to make improvements on the replacement property or even build a property. However, same timing rules apply, so you would have to have all that construction done within the 180-day window. And as you know, that could be difficult at times in some places, depending where you are. The permitting alone might use up a big chunk of your time. So those exchanges I don't see as often. They are out there, they do happen, but by far the most common is that delayed exchange that we talked about, followed by the reverse exchange. So next, let's walk through an example of a typical 1031 exchange. So this is going to be a delayed exchange. We're going to say our taxpayer, we'll call him Gary, owns a property. Let's call it property A, bought it for $2.5 million. So far, he's taken $1 million in depreciations. Now he's got an adjusted basis of $1.5 million. Whenever you sell a property, your gain is calculated based on the adjusted basis. And that's true whether you took depreciation or not, because your adjusted basis is determined by the amount of depreciation allowed, not the amount of depreciation taken. So make sure you're taking your depreciation deductions. Now, we're going to say in 2023, when his property A had a fair market value of $3.5 million, our taxpayer, Gary, successfully completes a 1031 exchange for property B, which has a value of $4 million. So he's going to exchange his property that's worth $3.5 because it's appreciated by $1 million, plus $500,000 cash to close the deal. Now that could be his own cash, borrowed money, but he's going to somehow make up the difference to get to that $4 million, because that's the value of the new property that he's receiving. Now, his basis in the property given up, property A, will roll over. That adjusted basis of $1.5 million, and that's the starting point for his new basis in the new property B. And that is also increased by the $500,000 cash he put into the deal. Old basis rolls over, any additional funds put into the deal add to your basis. So now he's got a basis of $2 million in this $4 million property. Now, had he sold his property for $3.5 million, which was the fair market value during the at the date of the exchange, rather than doing a 1031 exchange, he would have to pay depreciation recapture on the $1 million of depreciation taken, plus capital gains on the $1 million of appreciation. So he'd be paying tax on about $2 million at the recapture rate for real estate of 25% and capital gains of 20%, plus the 3% of net investment income tax on that appreciation. We're looking at a tax bill of about $488,000, almost the amount that he had to put into the deal. So he has a significant savings by doing the like-kind exchange versus selling. Now, let's take a quick look. We'll make some assumptions on the timing rules. So let's say he started his exchange December 1st. He has until January 15th, 45 days, to identify eligible properties to complete this exchange. Now, this exchange, the 180 days to close, is going to run past April 15th. 180 days from December 1st will take you out to May 30th of the following year. So if he wants to take advantage of the full 180 days, he's going to have to file an extension for his tax return to extend it beyond April 15th. That's how an example for the timing rules work. So we'll often be asked, how do you depreciate the new property? So as we just saw in our example with Gary, there's two components to the basis in the new property. There's the rollover basis from his old property that was $1.5 million, and then the additional basis from the $500,000 he brought to close the deal. So the general rules, which can be found under regulation section 1.168I, require you to depreciate the carryover basis over the remaining recovery period of the old property. So that carryover basis, the depreciation start date, is going to be the same as the start date for that old property that you got rid of. And then it'll be depreciated over the useful life of the asset with that start date. The additional basis for new money put in is that depreciation schedule starts the day the exchange is complete. And it'll be depreciated over the useful life of the new asset. So that could be 27.5 years for residential or 39 years for commercial. So you have two different items on your depreciation schedule. Now, there's an option to elect out of the regulations, which means rather than having two assets, you combine the rollover basis and that additional basis into one asset. Now, the trade-off is depreciation and will start on the date of the exchange for the combined value of the assets. So it'll start the date the exchange is complete and then go out 27.5 years for residential or 39 for commercial. So you're generally going to have a lower depreciation number when you elect out. But a reason you might want to elect out is if you'd like to have a cost segregation study done on the property. Under the normal rules, when you have two assets, carryover and the new basis, the cost seg can only be performed on that new additional basis. When you elect out of the 168 regs or the 168I regs and combine the carryover basis with the new additional basis into a single asset, now the cost seg can be performed on that entire amount. So there's some benefit to opting out if you're going to have a cost segregation study done. Now, another thing a lot of our clients do with the 1031 exchange is the IRS actually has a section in the code, it's section 1014, that allows for a step up in basis on inherited property. So you might hear the saying, swap till you drop. That's what's being referred to here, is you will use the 1031 exchange throughout your life to continually increase or trade up into new and better properties until you die. And then you leave that property to your heirs, whoever that may be, at the current fair market value. So all those locked in, or all that deferred tax, which would normally come due when you finally sell, gets reset to current fair market value. So your heirs that inherit the property, they can turn around and sell it the next day and pay no tax. There's going to be no gains because it got reset to the current fair market value. So going back to our example, let's say Gary holds that property that he exchanged into until he dies, or maybe he traded up. When he dies, the current fair market value of the real estate he has is now worth $10 million. And if he lived a long time, that original basis is probably fully depreciated, if not very close. So if he sold the day before he died, he'd be paying tax on close to $10 million in gains overall. However, the day he dies, that property goes to his kids at that current fair market value. They could turn around and sell it. They pay no tax on the capital gains. There's no depreciation recapture to deal with. So that, again, a lot of people refer to that strategy as swap till you drop. They plan to be in real estate their entire lives and pass it along, building that generational wealth. Now, one last thing to mention, 1031 exchange is great. However, sometimes things get a little difficult, especially with the timing. That's the most difficult part of a 1031 exchange. There's things that can impact you that are outside of your control. So something you should consider is what's sometimes referred to as a lazy 1031. And there's really two versions of this. First is look at your form 8582. That's the form from your tax return that tracks all your suspended passive losses. If you have suspended losses out there, you may be able to wipe out the gain or absorb a significant portion of it when you sell that property just by those losses alone. There's no need for a 1031 exchange. Another version of this is if you sell your property and you buy a new property in the same year, perform a cost segregation study and use bonus depreciation to generate those big year one losses, those losses can offset the gain from the property you sold. And so again, you might be able to minimize or even eliminate the gains from the property you sell. Now the key is with this one, you have to, when you sell your property, you have to buy the new property in the same tax year to make that work. But those are two options you want to consider whenever you're going to sell a property. And it may make sense to go with one of those approaches versus the 1031. Anyway, just make sure you're always checking and keeping your options open. So that about does it for today's discussion on the 1031 exchange or like-kind exchanges. I hope you found value in this episode. If so, please leave us a 5-star review, hit that like and subscribe button. Until next time, have a great day.
This audio segment was edited by me, Adam Rothstein. If you would like help editing your podcast or narrating your audiobooks, please email me at adamrothstein29@gmail.com. That's ADAMROTHSTEIN29@gmail.com.
So that about does it for this episode of the CPA Zone. Thanks for listening, and I hope you found something valuable that you can take away. We are taking on new clients, and if you'd like to work with us, then go to our website and fill out the client intake form on our contact page. This can be found at thepulicegroup.com/contact. That's THEPULICEGROUP.com/contact.